without further ado, it is my pleasure to welcome today's first speaker, Jason McGrath, Executive Vice President of Ipsos's Corporate Reputation Practice. Jason, you have the floor.
Thank you so much. Welcome, everybody. We're excited to have you here to talk about ESG excellence and how you can utilize ESG strategy to drive trust, competitive advantage, and of course, business results. As mentioned, my name is Jason McGrath. I lead our corporate reputation practice here at Ipsos in the US. And I'm joined today by our Global Chief Research Officer in the corporate reputation practice, Trent Ross, as well as a partner with our Ipsos Strategy 3 consulting group, Andre Galliano. Each of them will introduce themselves a bit more fully in their respective sections. Today, we're going to talk to you about where, in particular, top ESG execs are focused in the year ahead. And a lot of this research result comes from our inaugural ESG Council, a gathering of 35 top chief sustainability officers and others who are leading ESG initiatives at global organizations. We'll also share some of the most recent results from our Ipsos Global Reputation Monitor on what citizen consumers expect from businesses with regards to ESG priorities. And we'll wrap up today talking about how to build and measure effective ESG strategies, manage ESG risk, but also understand what is the return on ESG initiatives. So as mentioned, we'll start on the ESG executives themselves. Where are chief sustainability officers focused today? And these findings come from our inaugural Ipsos ESG Council. We conducted this research earlier this year, where we brought together 35 senior level executives who have overall responsibility for sustainability and the development of ESG initiatives and practices at their organizations. These are chief sustainability officers and others at global organizations, a sampling of which you'll see here. These interviews were conducted from the very end of last year through to this spring. They're in person, by telephone, or video call. And what we learned from this group is that the issues landscape is clearly changing quickly, and it's impacting the way that businesses operate, and as well as performance on ESG issues being influenced and shaping investor and employee perceptions. So from these 35 chief sustainability officers and leaders in ESG, what we found is 83%, the vast majority, agree that ESG is fundamentally changing the way businesses operate. These principles are becoming embedded across the business in different functions, and there is a role for everyone to play in a company's ESG performance. 91%, almost full agreement that a link exists between a company's ESG performance and its attractiveness to investors. And despite what we see in recent news coverage and the potential backlash and pushback on some ESG initiatives, this is definitely the exception as opposed to what most are seeing here. There still is a sense that there is a clear link between performance and this attractiveness to investors overall, because of the implications that ESG initiatives have on a company's efficiencies and operations and how it is ultimately operating to deliver not just financial returns, but also benefit to society. Additionally, ESG performance has a demonstrable link with attractiveness as an employer. Clearly, we're seeing growing demand from the employee base that companies are involved in key issues and also working to improve environmental impacts, social impacts, and also working in a highly ethical and transparent manner on governance issues. Also, from our ESG Council participants, 3/4 agree that it's the commitment of leaders within the business that is actually more important in driving change than pressure from external stakeholders. I'm sure we're all aware of where we've seen external pressures for companies to engage on key issues, to become involved in key initiatives. But ultimately, it's about that internal commitment that is driving change and less about companies taking a reactive stance to pressures from the outside. Ideally, when those are aligned, there's greater impact and greater initiative, but it is ultimately driven in the views of these chief sustainability officers that the commitment from inside is more important in actually driving change. That said, what's fascinating about this is that the role of the Chief Sustainability Officer, or its equivalent, has become a strategic leadership position within organizations. As the impacts of ESG are felt across the business and the demands are growing from various stakeholder audiences, 9 in 10 of these Chief Sustainability Officers agree that they are taking on a much more strategic leadership position within the organization. Now, that comes with opportunity, but it also comes with challenges. As this one participant mentioned, that it's interesting that the CSO role really doesn't have as clear a definition as some of the other areas like Chief Human Resources Officer, Chief Financial Officer. What that means for folks in these positions is there is a need to be nimble across the business. They're really working in a variety of different areas, talking about a variety of issues. And so therefore, it requires high levels of collaboration and high focus on where there is an opportunity to prioritize impact and benefit to the organization. From our council participants, there is also recognition that there's still a long way to go. 80% of our council participants agree that business has a long way to go before sustainability is fully embedded into every function, process, and role. So while we recognize, and our research shows, that there are expectations for business to have meaningful impact across each of the 3 pillars, E, S, and G, it still requires input and a change in the culture at organizations ultimately to truly embed this throughout the organization. The other difficulty and the challenge that Chief Sustainability Officers face is that there's agreement broadly, 83%, that the KPIs and standards related to ESG compliance and benchmarking are too fragmented. There are different frameworks. There are different areas of prioritization. Different stakeholders require or expect different initiatives. And until we have one clear agreed upon framework to truly measure not just expectations, but impact, we probably will still be operating based on varying needs, varying levels of focus in different areas based on a company's own assessment of alignment to those stakeholder needs. And so we see here this quote from one of our council members as well, that there is clearly interest in risk management and assuring return on investment. And there is this expectation that it's not just about return on investment, though, but also about the value that's being generated for society and the role that companies are playing in the communities in which they operate and for the various stakeholders that they serve and those varying needs. All of that said, when we ask our council members, how well overall do you think the business community broadly is doing in progressing towards the ESG commitments that have been set? What we find here is also opportunity for further work to be done. Very, very few indicate that the business community is doing very well. Half indicate we're doing fairly well, but you can see that there's almost a third who still say that businesses overall are doing not very well or not at all well. So clear room for improvement. Clearly a way to go before we see ESG principles embedded in all areas of a business. And so to get a deeper understanding of, well, how are companies actually performing on this, we conducted a second study. And this is one that we conducted in both Canada and the US amongst a general population sample in each of those markets with 3,000 respondents. We launched this just this month, and it's called the Ipsos ESG Watch, where we're evaluating public perception relative to performance on ESG issues for 30 leading companies. And we've then aggregated that data to an industry level to understand how are these industries performing in terms of the expectations of the general public. And so what we find when we aggregate all of this data is that there's still room to go, right? So when we look at the highest score, the data on the left here, this is the individual company across all of the different sectors that we evaluated that is scoring highest on 2 questions. First is, do you think that this company is having a positive impact, a neutral impact, or a negative impact on the environment, on society, or doing a good job on making ethical business decisions in compliance with the law, E, S, and G. And you can see that for the highest performing company across all of the sectors that we evaluated, only 39% of the general public in the US indicates that this company is having a positive impact on the environment. 45% indicating that the leading company across sectors is having a positive impact on society, and 41% indicating that the leading company across all sectors is doing a good job at making ethical business decisions and compliance with the law. What's interesting is, again, this is across all sectors. We cover tech, we cover CSR, we cover food and beverage, and we cover oil and gas, as well as a few others. Still room for improvement, for sure. And each of these three, this 39%, this 45%, and 41%, are actually representing a tech company in this case. The lowest scores, though, on these, 12% for a company having a positive impact on the environment, 14% for positive impact on society, and 16% on governance issues. What we've done here is we've excluded the oil and gas sector. We found generally poor performance for the oil and gas sector with regard to some of these issues. And we want to demonstrate that there actually is still low performance for others in other industries as well. And so on this, what we find is positive impact on the environment. It is a low score for a tech company. Positive impact on society, it's a low score for a QSR company. Doing good and making ethical business decisions in compliance with the law, again, a tech company. And so what's fascinating here is we see a tech company performing highest, but also a tech company, different tech company, performing lowest. And so there are wide differences in company performance that are impacting those overall sector scores. We then asked a second question. We asked, do you think that this company, their impact on the environment, their impact on society, and their impact on governance issues, ethical decision-making, compliance with the law, has improved? It stayed the same, or it's worsened over the past 12 months. And what you see here are the percentages for respondents who indicate that performance has improved. And so again, we see that 31% say that a company, this is the highest score, 31% indicating that a company has improved their environmental impacts, 33% indicating impact on society has improved, and 29% that governance issues have improved, indicating that there isn't a lot of improvement here. There's clearly more room to be done. And you can still see very low responses for the lowest performing company across sectors, excluding oil and gas here, in terms of improvement in their performance. This indicates, again, each individual company needs to assess their performance on these areas against the expectations of stakeholders, as well as competitive benchmarking, if we're to truly be able to provide better strategic guidance on where initiatives will have a greater impact on the organization and a greater outcome for the society and stakeholders that are ultimately being served. And we also wanted to understand, is there a perception out there that companies are actually following through on ESG initiatives? Because what we found in another study of ours, the Ipsos Reputation Council, where we speak to chief communications officers and heads of corporate affairs, is that over time, these past few years, we've found overwhelming agreement that companies are using the language of social purpose without committing to real change. So we wanted to understand from consumers, are these companies specifically that we're evaluating, are they following through on their ESG initiatives? And reassuringly, what we do see is that the American respondents in our study are seeing these sectors as generally following through on ESG commitments, more so following through than they say not following through. And you can see here the overall sector average at the very top, 38% of US respondents indicating that yes, these companies tend to do what they say they're going to do. 19% saying they tend to not follow through. But what's more important here, perhaps, is the unawareness, this lack of awareness of, are companies really doing what they're saying they're going to do? 44% across the various sectors, simply indicating, I don't know. I don't know if they're doing the things they say they're going to do. So it highlights that communications gap also. And if we're to use ESG strategies as a way to drive trust, which we see in our research that ESG initiatives are having a greater and greater impact on driving trust in organizations, that we actually have to make sure that they are also coupled with the right communications and stakeholder engagement strategies to ensure that impact is being heard across our various stakeholder audiences. So this overview of what chief sustainability officers are focused on and prioritizing and how they see their roles, coupled with consumer expectations, where we see various companies and industries performing, leads us right into the next section, which is what specifically do citizen consumers expect from businesses today? And for this, I'll turn it over to our Chief Research Officer, Trent Ross.
Thanks, Jason. I'm going to walk through results from a couple of our global studies. These are both fielded on our Global Advisor platform. Citizen consumers in over 25, 30 markets, depending on the wave, over 1,000 interviews per market, so very robust sample findings. And the first thing that we see is that broadly, people agree that companies can make money and support good causes at the same time. And that's really the goal of sustainability, is to be a win-win, meaning that companies can do well for themselves while doing good for society. And in fact, actions that companies take that are perceived to be more in alignment with their ultimate goal of doing well for themselves and making money are actually seen as more authentic and credible, because people understand why why companies are taking these actions. When you look at the individual commitment to ESG, people are in broad agreement, at least in what they say, that it's important that companies take action, and that if companies don't take action, that they will stop supporting that company. Now, there's of course a say-believe gap here, but we have seen increasingly that people are willing to take actions around ESG. And in fact, I think the risk of not taking action is even higher. So over half of people around the world say that they have changed their purchase behavior or boycotted a company because of ESG concerns. The other piece of this is, who do people expect to act and who do they perceive to be acting? Generally, citizen consumers believe that, yeah, they should be acting and that they are acting. They think they're doing enough. Where they think that entities are falling short is on government, where the vast majority think that governments need to act, but only about a third see government acting, and private companies, where there's a big gap between who should be acting and who is acting. Now, in consumer perceptions right now, the people that are perceived to be doing more than their fair share are scientists and NGOs. This just brings us back around to the point about credibility. If companies want to be credible about what they're doing, they need to form partnerships with people in the science and NGO community, because those groups are more likely to be seen as actually taking action. And most people don't think that business leaders tell the truth. Now, this is a sad reality, and if you look at politicians, it's even worse. But again, if you can leverage the equity of people who are more likely to be seen as telling the truth, such as people in NGOs or scientists, and those are the organizations that are perceived to be more willing to act, then companies are going to be able to borrow that equity to make their actions more credible. If we look at what people want from ESG, we see a lot of companies taking action in the environmental space because that's what they perceive that people want from an ESG commitment. But actually, when we ask people around the world, what is most important for multinational companies to address, social issues, improving society, actually swamp out environment and governance in terms of what people want multinational companies to address. But that weight, whether it's environment, social, or governance, does change by industry. So for instance, if we look at the automotive industry, you can see that what actions people want the automotive industry to take are generally in the area of environment, reducing carbon emissions and innovating new modes of transport. But there's also a pretty strong desire for affordability and accessibility and safety of products. So for automotive, the focus is more on environment than on social. But if we look at the next sector here, and again, this is global data, if we look at food and beverage, it's much more about social aspects of safeguarding consumer health and removing artificial ingredients, followed by packaging, which is the big environmental concern. Carbon actually comes much further down the list for food and beverage because, again, the greater concern is around plastics and packaging. For financial services, it's much more about governance. So we've seen a sector that needs to focus on environment, one that needs to focus on social aspects. And now here's financial services with the strongest focus being on governance in terms of combating corruption and crime, curbing executive pay and bonuses, and paying an appropriate amount of tax. These are much bigger issues for the financial services industry. In the oil and gas sector, as we might expect, the focus is on environment and protecting communities from environmental impacts, which is classified as social. But if we again look at technology, okay, so now we're back to an industry that needs to focus on governance, on cybersecurity, and preventing the spread of misinformation, but also on society in terms of respecting the privacy of internet users. So if we look at these industries as a whole, we can see there's a lot of different focus areas here, which means that while a generalized focus on society is more important, if you look at it by your industry, you're likely to get very different results. That's why we use our ACE framework when we're speaking with our corporate clients about actions they should take in sustainability. The first portion of this framework is to be authentic. So companies need to be taking actions that align with their business, right? And that focus on their value chain. If you are doing something that is seen as being aligned with your business, it's much more likely to be seen as authentic. You're much more likely to avoid accusations of greenwashing on one hand or of being woke on the other if you're doing something that's aligned with business, something that is perceived as a win-win rather than a straight corporate contribution. The second piece of the framework here is credibility. As I mentioned, companies can't assume that they're always a credible actor in this space. Oftentimes, you need to partner with someone in the NGO or scientific space who's active in this area in order to borrow equity from them. The other piece of credibility means aligning with what people want from industries. Again, if you are, if the data that I just presented, some industries, the desired focus is on governance, some it's on society, and some it's on environment. And if you align with these external realities, you're much less likely to get yourself into a situation where people, A, wonder why the heck are they doing something that no one thinks is important, and B, why should I pay attention to this? This doesn't make any sense to me. And then finally, these actions need to be effective. But effectiveness isn't just about generating goodwill amongst your stakeholders. That's important because that builds your reputation, and we know that building reputation builds business performance over time. But these actions also need to be effective in terms of actually creating social change. Because if you're not actively creating social change, then eventually the authenticity and perceived credibility of your actions is going to decline because they're not actually doing anything. So you have to evaluate your real world impact along with the impact on your reputation and on your ESG metrics. With that, I'll pass it over to Andre to talk about a deeper measure of effectiveness.
Thank you, Trent. Very, very interesting topic indeed. And now we're going to discuss how we can shift this conversation to a more financial perspective and bringing the ESG knowledge and ESG impact to financials. And this is the main challenge or the challenge on top of other challenges, of course, of understanding ESG as a strategic initiative for companies to build value. The main question that we get asked is, does ESG generate financial value? Is it possible to isolate the effect of ESG initiatives in revenues, in sales? And the answer is yes. Yes, of course, there is a way, and we were going to outline how we can do that. But most importantly, we need to understand that ESG investments are not only be impacting revenue streams. So if we only consider ESG as a tool or as an initiative to improve consumers' relationship, we will have a biased view, because most of the return of ESG investments and initiatives are perceived in a number of different stakeholders, and of course in making sure that a company has an optimal cost structure by improving relationships with a number of different stakeholders, like society, like Trent just said, communities, financial investors, employees, attracting talent. And if we are able to manage and to improve all those relationships, it means financially that we may need to spend less to retain those relationships and to improve those relationships, and that's financial value. So financial value is not only considered an impact on an uplift on sales, on revenues, but also, and most importantly, on future cash flow. So that's the bottom line of the bottom line. And how we do that, we have three steps to understand the landscape, benchmark performance, and measure impact, as we just seen in the presentations of Jason and Trent. Firstly, we need to understand how our ESG initiatives are performing in internal stakeholders and the public. How do we compare nationally within our sector? And we do that through internal interviews, perception research, and uncovering, of course, what are our ambitions in terms of ESG. If we are to be authentic, like Trent just said, we need to understand what is our vision for the business, our vision for the brand, and our vision for ESG as an initiative, as a value lever to bring value to the company. So this is an inside out view, and that we also compare with other stakeholders, with other competitors, and benchmark versus competitors. Then we see what are the top issues to be top ESG issues to be addressed. How do expectations differ across different stakeholder groups? So of course, if we're talking to communities, the needs that they might have may differ from those who are investing on the company, or for those who are investing their time on the company by working and deciding to work with us. So each of these decisions need to be measured, of course, in order to understand how ESG may play a role in influencing that decision. We do that through integrated survey, digital and regulatory data, diverse audiences, and the power, of course, of research and insights within Ipsos may help us achieve the right diagnosis in terms of where we stand related to ESG investments. Finally, we can then measure impact. So what impact of our various investments may have on the business, what is the economic value of ESG actions, and what is the brand uplift and ROI of those initiatives. And again, the brand uplift in terms of each of the stakeholders' decisions towards our company, and ESG isolated as a tool to improve those relationships. So that is where the value lies. That is where the financial valuation lies. This is how we approach it. So if we move to the next slide, please. Yes, thank you. So this is the ESG valuation methodology. And this is not a black box methodology. This is not something that Ipsos has developed that is not transparent. It's completely transparent. It is open, and it's derived by the business valuation methodology, which is, by the way, outlined in the ISO 10668. It's the international standard on monetary brand valuation. So we need to understand ESG investments as a financial asset, as an intangible asset that may generate future return for the company, and we need to bring this to net present value. So it's the same methodology that any any investment bank or a CEO or a CFO would make use of to understand the value of a company. So it is derived from a business valuation model. So to understand the value of a business, we may look into revenues, yeah, but most importantly, we will look at the investments needed to support those future revenues. And this is when we change the conversation to talk about future cash flows. So in a business valuation model, traditionally, we will look into future cash flows, and there's a risk associated to those future cash flows. The same thing we will do to isolate the effect of ESG. So basically what this methodology does is it understands the brand uplift as a consequence of investing on ESG. For instance, the fact that we're investing on ESG may be a driver of decision for employees to work with us, so we can retain employees. And if we weren't doing those investments, we would lose some of those perceptions. That same principle can be applied to talent, to the acquisition of talent. That same principle can be applied to the acquisition of the relationship with suppliers, with financial investors that decide to invest in our company, to buy stocks from our company because they believe that ESG investments that we are conducting may help bring a more sustainable economic growth. So what we do is each of these relationships, through research, we understand the effect of ESG, we isolate that effect, and as a consequence of that, we have ESG profits, which is future cash flows exclusively associated to those ESG initiatives. And this is the key message that, and the central part of the methodology, because it's how we link investment and effect. Again, it is not only about improving revenue, it's about sustaining revenue in the future. And what about industries that are operating in monopolies, or industries that cannot really drive volume or price, but does that mean that there is no value in ESG? Of course not. There is value in ESG in those industries as well, especially if we look at the cost perspective, operating from a financial perspective with a better cost environment. And that, again, will have impact on the bottom line, on the ESG profits that we talked about. Finally, those profits, those future profits exclusively associated to ESG, they do have a risk, just like the risk of the business. But the risk may differ as a consequence of being well positioned on brand strength, on awareness, on advocacy, on other key brand and ESG metrics that we will use to benchmark a company versus competitors, and to see if the risk of those ESG profits, future profits, is the same as the risk of the business, or it may even be a risk that is not as high. So we would have a lower discount rate to those financial results, future financial results. And that is how we arrive at the final ESG value generated by a given initiative. So this is the typical methodology. It is used for M&A, for mergers and acquisitions. It is used for understanding the value of brands, of sponsorships, and of course, understanding the value of reputation and ESG. So in synthesis, if we move to the next slide, please. When we do a ESG valuation, ESG economics, or ESG ROI project, basically what we're doing is we are linking research metrics and ESG metrics and isolating the effect of the uplift that comes from ESG. We build that into a financial model, which is based, of course, on internal assumptions, but we are valuing the company. So what we're saying is ESG may be a percentage of the total value of the company. And that is the value we would lose. So it's not revenues again, so it's value of the company. It's even more important than revenues. It's what it remains after revenues, costs, expenses, etc., and capex and future investments. So we are securing a percentage of the value of our company by investing on ESG, and we can know what that percentage is. How does that transform into ROI? So basically what we do is, since we have the brand uplift, we have the ESG economic benefit, and we have the value generated by ESG, we divide it by the total investment, which may be the cost of contracts, if we have a specific contract with a specific initiative, but also the cost of activating those assets. So the total cost utilized or directed to a given initiative, and we divide one by the other, and then we have a multiple, which is the ESG ROI. So basically the minimum we would need is a multiple of 1, right? So per each dollar invested in ESG, we would be returning in business value $1. So that's a positive or effective ROI. We have seen cases where we have a very high ROI for a given initiative, and still we have recommended not to pursue or to keep pursuing that particular initiative. Why? In light of other investments. So how can I make the most of my $1 if I have 3 or 4 or 5 different ESG initiatives, and all of them are profitable, all of them are bringing return to the company, but I see that 2 or 3 are competing for the same territory, strategic territory, we may even recommend moving the money away from initiative A to initiative B. So this is what we talk about when we're saying optimization scenarios. So we can provide a recommendation on, does it make sense investing in a particular initiative? Yes or no? What is the maximum value we should be investing in that initiative to still maintain a positive ROI? And then on top of that, what should our strategic priorities be to better activate and to better capture value from that particular ESG initiative? So in the end, what this project does is it tells you if it generates return, it tells you what is the maximum value we should be spending on ESG, and it improves the return, the financial return. So it changes the conversation with the CFO. We no longer just come to the CFO or to the CEO by saying, hey, we know that the brand trust is increasing, and he might say, fantastic job. What does that mean in terms of US dollars? And now we can talk about money. We can link ESG with financial value generation, and this completely changes the conversation. We are able to make rational decisions on where to invest and even how to capture more value from the investments that we already have. And again, as Trent just said, for it to be effective, it needs to have impact on society. It needs to have impact on other stakeholders. So what we're doing is we're measuring that residual impact for society, and we are transforming that impact into a tool, a powerful tool to value, for a company to value the return for that investment from a shareholder or investor perspective. This is what this methodology does. This is how we link everything we've seen today with financial value generation. So finally, to sum our conversation, to wrap up our conversation, the next slide, please. We can see that when Ipsos talks about ESG, we may approach it from a number of different initiatives. So for instance, to ESG Watch, high-level priorities and performance, to understand how our company is performing in terms of ESG, in the perception of citizens, how do we compare nationally within the sector. We may have risk audits and risk landscaping and benchmarking, what ESG issues are top priority to address, using the ACE methodology, for instance, to define and to prioritize which of the initiatives make sense to our company, because it's something that we do, it's credible, we love to do, our team will love to do, it's in accordance to our brand platform, it's in accordance to what's relevant to all consumers. So this is what the ACE model does. And finally, we can build business cases considering those opportunities, opportunity A, opportunity B, and versus the investment required to deploy initiative A or initiative B. We can tell clients which should be the prioritized ESG initiatives that will bring more value to society and to the company. And finally, we can have the RISE methodology for ESG measurement and risk monitoring to see if there are other risks, emerging risks, opportunities to do this in a very quick way in order to be able to reprioritize or shift our strategy in accordance to trends that we've seen in the market. So this is how we conclude our webinar today. I'm going to invite back Jason, please, and Trent. We discussed a lot about financial value generation, starting from understanding reputation and understanding ESG, and we may have a few questions that we'll be happy to answer now.
Fantastic. Thanks, Andre. Thank you, Trent, as well. I do encourage, if you do have any questions, please go ahead and pop them in the chat. We have some time that we'll get to them now. Of course, if we do run out of time, or if you have questions at a later point, you can always enter them here and we will still be able to address them by email after. The first question is, what is the linkage then between reputation and ESG? And do you focus first on really building an organization's reputation or on becoming more well-known for your investments in ESG? Trent, I'd like to direct that one over to you on kind of these linkages and what we see in the research that we have.
Yeah, I mean, really, it's a virtuous cycle, right? If you don't have a strong reputation, then your ESG activities won't be credible. But we also see that ESG activities are playing an increasingly strong role in driving reputation. So you really have to have both, really, when you chicken and egg it, you just end up not going anywhere. So investing in ESG in order to build your reputation is quite positive, but you also have to have a positive baseline reputation in order to get started.
Fantastic. Thank you, Trent. I see one other question here, and this one is that you mentioned developing a deeper understanding of what key stakeholder groups expect you to prioritize on ESG as the right starting point. But what types of analysis and data sources should be part of that? And I'm happy to address this one myself. So we have a number of tools, as you've seen here with our ESG toolkit, to understand what those priorities are. This would, of course, include, as Andre mentioned, primary research, simply surveying and speaking to key internal stakeholders as well as external stakeholders. That might include employees, prospective employees, local communities, investors, policymakers, and the general public to understand expectations of the organization, key social issues and causes that those audiences care about, and understanding where your sector and your company specifically have an authentic role to play, one that can be credible, and ultimately effectiveness in those areas, the ACE framework, as we mentioned. The other piece of it is also digital tracking and understanding where our key stakeholders ultimately focused on in terms of conversations, news articles, policy and legislative priorities from a regulatory standpoint to identify risk areas that require your focus and the creation of initiatives to address those areas, and ultimately driving alignment between the business and those external realities. And where credibility needs to be enhanced, it again comes back to that ACE framework and understanding where are there potential valuable partnerships where you and a partner organization can more credibly address some of those key issues. And that's how you ultimately determine those priorities and then monitor for changes over time, as this particular area is changing quite frequently and expectations shift. It's important to keep a finger on the pulse of where key stakeholders are. Andre, Trent, anything to add to that?
Yes, so as you said about the ACE methodology and defining what's important, because one thing is measuring, right? And it's essential to measure. It is a starting point. We also need to look internally to the company's capabilities of really delivering what's expected of them. So that's why authenticity makes sense. And this is how we also can make the link with financials, because we need to see it as a business strategy. In the end, the decision will be made from a company's perspective on how many dollars should I be spending on this or that, or advertising or training or acquiring a new tool for the company. And by bringing financials to the discussion, we are able to really shift the conversation. But we have to start measuring, we have to start prioritizing and making this link.
Yep. And, the more hard-nosed companies are about their ESG strategy, the more that ESG needs to pay off, the more authentic and credible it is. Companies shouldn't be taking this lightly. This is a business decision that should have real business impact.
Yes, and if I can mention a quick case that I think it's illustrative, and this case happened to a very large bank in Brazil, one of the largest banks in Brazil, actually, that was really always investing in ESG, and they found out that it was important to invest on the day without meat, right? They wanted to promote this, and it's okay that they did that. However, when they launched this campaign in the same day, in all over Brazil, in front of the branches, consumers were cooking barbecues to protest against this initiative, not because the initiative wasn't correct, but because that particular bank always supported the agribusiness and the agri. So that bank was built with meat and with the meat industry. So how can they talk about a day without meat? That's not authentic, even though it's relevant, even though it's important. So these are the type of risks that a company can face if they're not looking into a broader, using a broader lens to understand return on their investments.
Great case, Andre, especially demonstrating that need to understand where is the authenticity, as well as where can you credibly have a voice on these issues. Those are all the questions that I see in the chat. Of course, again, I do encourage, if you do have any follow-up questions, to please reach out to myself, Trent Ross, our Global Chief Research Officer for Corporate Reputation, as well as Andre Galliano, partner at Strategy 3 in our strategy consulting group. I appreciate you taking the time to participate in this webinar with us. Materials will be sent out following the session today, and there are a few downloads also available through the session today on some of our supplemental research. But I want to thank you for your time and hope you have a wonderful day.
Thank you.